Here's something the banks never tell you when you buy a home. Now, I'm a mortgage broker and I've helped hundreds finance real estate. Now let's get into it. So what they don't explain up front to buyers is that your payment that you have on the closing day is going to be very different from the payment that you'll have a year from now, and it will be much higher. And although they advertise that your payment is going to be a fixed rate for a full 30 years, this is only partly true. So when it comes to a mortgage payment, if you have a fixed rate mortgage, the principal and interest is fixed. That will never change. But what can change is going to be the property taxes, because that rises yearly, which will make your mortgage payment go up. And this is the part that surprises many buyers later down the road. Now let's go over why the first 2 years of your mortgage will be the most expensive. The seller's low property tax bill, which is what your mortgage payment up front was based on, does not get transferred to you. And what ends up happening is after you close on the home, the county will reassess the value of the home, which is going to be at a higher purchase price, which will that cause a higher property tax bill. And what the county does is they're going to notify your mortgage company and say, hey, look, here's the new tax bill. And if it's a lot higher, that mortgage company is going to have to readjust your payment and include that increase into your payment. Now let's go over a real life example. So here's how much my mortgage payment increased due to my property taxes. So I bought a home back in October of 2023, and the tax bill the mortgage company used based on the seller was around $3,300 for the year, which equates to about $282 per month. That was included into my monthly mortgage payment. Now, because everything gets recorded once you buy a home to the county, they know exactly how much the home was sold for, how much the appraised value was. That next year, the home gets reassessed for the new purchase price or the new assessed value. And in Florida, the new property tax bill comes out every November. So November of that next year, the new property tax bill came out, and it was around $5,700 for the year, which increased my payment almost $200 a month. Now, if you think this is bad, it gets worse with new construction. Now let's go over that. So if you're buying new construction, this is where homeowners can get hit the hardest, because your payment up front can look extremely cheap because the property taxes are based on the land only, which could equate to around $50 a month. Then what ends up happening is a year later, after you buy the home, the county reassesses and they base the property taxes on the land plus the home, which can increase your mortgage payment almost $1,000 a month, or in some cases even more. And many new construction home buyers are most vulnerable to this, because if their lender does not take this into account up front and tries to put in a cushion for your property taxes so you don't have such a huge increase in payment, then this will happen to you. Now let's go over some tips to help mediate this. So here's a tax saving secret that many homeowners miss out on, which is filing your exemptions. And these exemptions will help permanently lower your tax bill. And if you end up skipping out on this, you could end up wasting thousands over time. So what you want to do is you want to either go to your county website or go to their office and see what exemptions they offer and see which exemptions apply to you. Now, this is free to apply for. They'll tell you exactly what you need. They'll also tell you how early that you can apply for these. And what ends up happening is they'll adjust your tax bill to a lower amount based on the exemptions. Now let's go over tip number 2 to help lower your tax bill. And here's what the county hopes you never figure out, is that you don't have to be stuck with a high property tax bill for the rest of your life. So here's how to do this. Number 1, you'll want to file an appeal. You're going to file this directly with the county. What you're specifically appealing is not the high tax bill. You're actually appealing the assessed value of the home. And so you'll need to bring proof. So you'll need to bring comps that they're over-assessing your home. And 2, you can also you can file an appeal to help fix any type of errors. Number 1 biggest error that the county misses is the square footage of your home. So if they're putting your home at a higher square footage and they're overvaluing your house because of this, this is the way to fix it. And then when they lower the tax bill through this appeal process, this will lower your mortgage payment. So if you think renting is going to save you in this case, you're wrong, because landlords face the same issue with rising property taxes and rising home insurance costs. But what they do is they don't absorb it, they pass it along to you. And that's why rent continues to increase between 5 to 20% annually. So at least when you own a home, you're building up your own equity. So here's some simple steps to help protect you from becoming house poor. So number 1, don't max out your pre-approval amount. Also, give yourself a little bit of wiggle room with the payment and know upfront that your payment will go up a little bit over time. So if you're planning to buy a house and you want to know exactly how much buying power you have, click on the link in the description, schedule a call, and I'll be in touch.